Kyle, I've known for years. He's one of my favorite people in real estate. And I'm excited to have him kind of talk because, like I said, I know some of you guys are still looking to buy more potentially, which excites me, and I would like to help you with that. So some of that's just information and different programs we have. So with that, I will turn it over to Kyle. He can introduce himself, and then he can go through his presentation.
Excellent. Well, thank you, Derek, and thanks again for allowing me to be part of this. Known Derek for a number of years. When I moved to the area, he was actually one of the first individuals that welcomed me in the title business at the time, and moved on to greener pastures, of course. But appreciate it, Derek. You've been a great friend. But so my name's Kyle Torgerson. I work with Premier Mortgage Resources. I've been doing lending in my 20th year. I started in 2005. Which was a great learning experience and having gone through the subsequent years. But it's lent to some really great ability for me to gauge and look at the market in a way that is different for those that are just in the market within the last decade. But anyway, Premier Mortgage Resources is a growing mortgage company. It's primarily focused or ran out of Idaho and in the western United States, but it's spread to other states as well. I believe we're in 32 of the 50 states at this point. And we feature a lot of things that are different, mostly just easier to work with. Everybody knows that financing, especially in this day and age, can be a little bit cumbersome and difficult. We try to minimize those difficulties as best we can to make sure that our investors or our clients get the best service possible. And so with that, of course, real estate lending has been a little slower. Weston and Ryan kind of addressed a few things that are happening in our market. I won't rehash that because it doesn't need to be. We all see it. We all feel it. But there's some really positive things that are happening in the investor side of things. Derek, I'm not sure how to get my presentation on. Is that something I share, or is that something that Sarah puts on?
You should be able to share it. So if you want to try to share your screen.
Excellent. So again, Kyle Torgerson, I'm a senior loan officer for Premier Mortgage Resources. One thing that we do a little different than a lot of lenders is that we simply want to aid in construction or investing from the ground up. And so we can do a number of things that others can't. First of all, we can lend up to projects up to 10 million. A lot of lenders will cap it at 3 to 6, and so we can handle some pretty big programs and projects. Multi-unit, with residential lending, 4 units is the most you can do. We can broker and go higher, but for ground-up construction, we limit to 4 units so that we can sell those on the secondary market to Freddie Mac, Fannie Mae. We have a cap of 85% loan to cost. Loan to value, of course, could yield a little higher loan to value, but we limit it to loan to cost. Those are interest only draws and interest only payments during the construction phase. And we have a pretty generous term of 18 months. And so big projects are no problem. 18 months should be sufficient to handle most. Now, the one thing that this doesn't cover is infrastructure. And so land has to be shovel ready. Plumbing, all connections now have to be available for these things. But typically, in most areas that are more suburban or urban, that's not an issue. But we can also lend to an LLC instead of an individual. So it's kind of nice to relinquish that or create that separation and corporate shield that is really nice to have for investment. One thing that we do a little different too is we can have a fix and flip. If it's existing property that just needs a facelift, we can help cover those and turn them pretty quickly. Again, up to 4 units. We can finance up to 100% of the rehab, up to 90% of the purchase price, and so it's a pretty great program where you can actually have a pretty high loan to value. 12-month term on that. Interest rate is between 9.75% and 12.5%. Again, interest only during that construction phase. Draws are not an issue. You can fund those or get those as often as you need to. Lend again to individual entities or individuals if required. But with this and the one prior, we do want to make sure you know what you're doing. If you've had programs or projects like this in the past, we want to hear about it. It's kind of a case by case at times, especially when we're getting in bed with a new investor, making sure that they have an idea of what they're doing, so that there aren't any issues that could be eliminated with just a little more experience. And so those are really great. Actually, have helped a lot of individuals do these because there's a lot of distressed properties. Individuals are looking to turn those. The price point on a lot of initial buyers or first-time home buyers has been lower, and so buying those distressed properties, dumping some cash into them to turn them and keep them still at a limited price point is something that has turned a profit for a lot of investors, and so that has become something quite attractive. DSCR programs, these are quite common. They've been around for a number of years. I have experience in commercial lending. DSCR is actually something that's very familiar to me. We just simply want to make sure that the income received is enough to cover the expense on the home. That's principal and interest, taxes and insurance, PITI. And so as long as we have a one-to-one coverage on those things, we're good to go. There's no limit on number of properties financed. Fannie Mae and Freddie Mac are going to have limits on what they will allow financed. I believe Fannie Mae has up to 9, Freddie Mac is 6. And so there are limits inherent with those conventional programs. This is a one-off where you don't have to worry about those conventional limits. And again, with experience, as long as the property covers its own expenses, we don't care if this is your first transaction. We just want to make sure that it fits that one-to-one ratio. Loan amounts are kind of generous. $100,000 property up to $2 million. Let's see here. Again, 2 to 4 units, not a problem. 30-year term. There's no prepayment penalties or anything like that. It does require 20% in, but with investment properties right now, that's kind of typical. They used to get away with a 15% or 10%. The market's kind of retracted a little bit. It does require 20% investment from the buyer, but pretty gracious terms all around, though. I've been pretty excited about this program. Are there any questions with regard to these programs I've talked about, or any questions for programs I haven't discussed that you're perhaps interested in?
On any of these programs, are you able to take into account the income to help you qualify on the rent on the
Are you
properties?
talking about the individual's income?
The property's income.
This one for sure. Debt service coverage ratio, that's all we actually look at. We actually don't require any income documentation for the business or the individual on this DSCR. We simply say, what's it going to lease for? This is what your payment is. And so these are nice because it's a very low doc. It's a low doc transaction, so it doesn't require much. On the others, yeah, we're going to be looking quite heavily at, what is the overall global cash flow, and typically what that looks like. So really great question. Juanito has a question: average interest rate on a cash out refi and average fees to pull cash out on a refi. That's a really good question. It's going to be inherent to what your credit score is going to be, as well as what our loan to value is going to look like. Cash out is a little worse on rate. Okay, single family home, perfect. Is it investment or is it your primary? That's another thing that we're gonna look at. So investment home. So 820 credit, fantastic. That's really commendable. Investment property, we're probably going to be limited to a few things. 75% debt to income, or sorry, not debt to income, but loan to value. Interest rates on that are not going to be incredibly sexy. Right now, we're going to probably be mid to higher sevens, if not dipping into the eights. Interest rates for DSCR, kind of same story. They're going to be looking at, well, they're going to be looking at the cash flow ratio itself. It's a little higher than 1. You get a little bit of a bump, but typically we're going to be looking at market rate plus probably +1, which is probably at this point in the day going to put us at the higher sevens. As far as average fees, to answer Juanito's, for us, we charge a $1,600 processing and underwriting fee. Everything else is third party. And so aside from those third party charges for taxes, or not taxes, but appraisal, title, we're going to look at rates. And if you choose to buy a rate down from par, that's going to be, in addition to your closing costs. But right out of the gate, fees are pretty minimal. Great question. Any other questions I can answer about these ones? Will rates drop this year with transition in presidency? Hi, Shauna, or Sean. That's a great question. I would expect so. I would expect that with a change of it could happen for sure. The last week has been a little bumpy with the economic news that we received from the Fed. Last week we got numbers that jobs were fantastic, that our unemployment was low, and so it's kind of funky because good news actually translates to bad news for mortgage, because it means the Fed is not as likely to cut rates. And so these unemployment numbers and things that we received last week, Fed chair had a reaction to it of, hey, maybe we don't need to cut rates as much this year. And so they backed off from projecting up to 4 to backing down to maybe 1, which put our market in a tailspin for a little bit on Friday and Monday. Today's kind of interesting. We had some new numbers come out that showed our manufacturing is not as strong as they projected in the US. And so because of that bad news, rates are kind of rallying today. And so I tell this because, as much as a change in administration can help, market rates or mortgage rates are bond driven, and because it is tied to a mortgage-backed security bond. And so it competes directly with the 10-year Treasury, honestly. And so if the 10-year Treasury goes up, so does the mortgage-backed securities market, which means rates go up too. And so the thing that's going to most influence our economy is a chance that the Fed could reduce rates. And I'd say if you want to keep an eye on what rates are doing, keep an eye on that 10-year Treasury bond, because it moves just right in sync. Mortgage-backed securities move right in sync with that 10-year bond. Today, the 10-year bond has dropped. Let me pull up my report, actually. I watch this pretty regularly. So today, the 10 years dropped 13 points, had dropped a little more. Mortgage-backed securities have jumped up 55 points, which again is a reduction in rate. And so everything we've lost from Friday through Monday has balanced out today, which is fantastic. And so a good day to lock a rate if you're looking to lock a rate. I would hope that it just continues to improve, but it's just depends. Come the 20th when we have Trump come in, it's kind of interesting to see. It'll be interesting to see what happens in the market, whether it rallies or if it has a perceived negative market there. And so a lot of unknowns. It's a different territory than a couple of years ago for sure. Great question. Hope that helps. But yeah, I expect rates to drop from where they are. I really do. I hope we get back into the low 6s, high 5s, hopefully by June or July. And that's on a primary residence, just to clarify. Any other questions I can answer?
Looks like you're good to continue.
Excellent. Well, Derek, my presentation is it's not 40 minutes. I
That's
apologize.
that's all right. If you want, go through what are some of the hurdles you are seeing with investors like trying to jump in, like just some of the hurdles that you're seeing, some of the opportunities you're seeing,
Sure.
and
Sure. The one thing that I've noticed, especially in our area, Iron County, Washington County, is there's a stagnation like Ryan and Weston were talking about. There are a number of properties that have been on the market over 200 days. And so, more of those are related to single family home properties that I've just kind of been watching on the MLS or driving around and watching those to see if people are going to bite. People are in a little bit of a holding pattern, again, like Ryan and Weston were talking about. And so sellers are actually a little more apt to come down on price or at least have some concessions. Whereas, 2 years ago, sellers weren't kicking in anything to help cover closing costs, anything like that. And so I've got a couple of borrowers right now that are negotiating with their sellers. The sellers are eager to move on. They in turn have homes that they're trying to buy, and so this domino effect is allowing them or causing them to react in a way where they're eager to dump the property, for lack of a better word. And so there's more opportunities now, and values are higher right now, and so uh, you may get a property at a bargain where you have some inherent equity if you're in the market to buy a property. Again, rates are a little higher than we'd like to see them, of course, but you know, rates are going to drop. Whether this year or next, we will have lower rates. But that instant equity that you gain by buying property at a discount is huge. Um, the investors have helped lately. They're taking advantage of that. They're finding homes that do two things. Give them instant equity based on their perceived value to what the purchase price is, and then the second is they're trying to make sure that those payments cash flow. And if they can at least break even for now, if not even take a small loss with the adjustments in rates that are perceived to come soon, again within the next year or two, those slightly negative losses or break evens will turn into positive cash flow. And so it's hard to have a long range vision on these things because there's so much uncertainty. But it's kind of a unique market right now if you're on the hunt for some value. Those fix and flips are a real deal, but um, you know, there's a lot of people that want to buy a home that is at a lower price point, and some of those fix and flips can allow for that. As far as hurdles coming in, I'd say the change from the loan to value requirements or the cash injections from the borrowers moving from 15%, which was quite common in 21 and 22, to 20 to 25%. And you can get away with 20. The rate is a little rough. 25% gets you in a better bracket for rate. So that has been honestly the biggest hurdle, is just that little extra requirement of down is now required in our market because Freddie Mac, Fannie Mae, those investors, they're not all that excited about investment properties right now. A few years ago, they were quite inundated with investment type properties, and they're just inherently a little more risky than someone's primary residence. And so, in turn, they're asking for more down and a slightly higher interest rate. And so, I'd say that's probably the biggest barrier to entry that people have slowed down on, is that down payment requirement. Excuse me. Trying to think as far as on the construction and investment side, those are definitely available. Like I was showing a few slides available before. Pardon me. They do require some documentation. And usually it's a 2-year requirement to show tax returns, those types of things. If you've been in the business for longer than 5 to 6 years, or you've had experience with investment properties a little longer than that, we might be able to get away with 1 year. But the documentation is still something we comb over pretty well. Now, those ones that are the fix and flip and the investment ground up, those are broker channels that we have. We're negotiating, we have negotiated with those brokerages to provide us top tier pricing on everything. And so we're a go-to for those investors to provide for them. So you get the best benefit there. These are a little bit better than private notes. A lot of individuals go with private lending. Private lending has its appeals. Draws are easy. You can have as many as you want. The turn time on those is quickly, but at the same time, those investors that I'm dealing with, they get it. They've seen that. They're trying to mimic that exactly, and so faster draws, unlimited draws, and they come pretty quickly. And so we have the same that any private funding would offer, probably at a bargain interest rate compared to what you get privately, though. So it can be a really good benefit.
Do you see in the near future lending becoming more difficult on investment properties, or then opening it up a little bit more and being a little bit more flexible?
You know, that's a great question, and that's, I think, one of those unknowns that's going to be dependent on what the next Fed chair perceives our risk is in our economy as a nation. But I would say that things have actually been pretty tight on lending and investment since COVID. It loosened up a little bit in 22 on some COVID rules, but I would expect that things will loosen up. I think if we can show some national strength in our economy, I think those not debt to income, but loan to value ratios will loosen up a little bit, where we'll move and kind of migrate back to only requiring 15% down. There were a lot of 10% and 15% down programs that didn't require any sort of mortgage insurance. I think we'll migrate back to those because things have been quite constricted over the last 2 years, especially. But yeah, I think that things will loosen up, honestly, unless we have something, barring anything terrible happen. I think things are moving in the right trajectory to loosen up a little bit. Let's see, Michael, your question. Derek mentioned that big construction and big management are moving into Cedar City. Are we starting to see institutional buying of single family homes here? I haven't seen any. I'm just trying to think. I haven't heard of any real estate agents mentioning that. Derek, do you know?
I haven't seen any. I know up north you're starting to see it. You're starting to see the Blackstones and stuff. What you're seeing more of, at least in discussions here, no projects have jumped off the ground yet, is those build to rent type projects, where it's either single family townhomes and they're built by larger investment companies for the sole purpose of they're just rentals. They're not big apartment complexes. They're just single family, twin homes, townhomes, condos, and they're all just going to be rentals. And that's what that larger investor is doing. I'm starting to see some more of those type conversations, but not like the BlackRock and some of those other larger institutional single family coming in trying to buy up like 10 to 50% of the market. We haven't seen any of those as of yet.
No, hopefully we're sheltered from that. But again, like you mentioned, a couple of big entities moving in. It could be in the horizon. Who knows? Just depends on what happens with our economy. But the one thing it does bring to mind is, in St. George, which is only 40 minutes south of Cedar City here, I've been speaking with a couple of my real estate counterparts, agents, and they're seeing a little bit of a bubble with Airbnbs, VRBOs, where a few years ago, a lot of people were buying those. They kind of caused a rally with investment buying in that area. And now a lot of those are coming on the market because and just perceiving, I guess, that disposable income Airbnb, VRBO isn't getting as many visits to those types of properties from individuals. Maybe just because discretionary income is a little bit less. Who knows? But the St. George market has a lot more listings for those types of properties than they've had in the past. A lot of people are just dumping those. And so, whether a bargain or not, I haven't dived into that enough to see if they're something good to pick up. But it seems with everybody, not everybody, but a lot of those coming on the market, they're starting to see a softening in that VRBO Airbnb market in St. George. And so something to look at. Maybe that'll be something that happens here in Iron County. I don't believe our short-term rentals were as saturated as the St. George market, but it's interesting to see those ebbs and flows in the market for sure.
Last year, we saw a lot of conversions from those short-term Airbnbs to long-term rentals. About this time last year, we saw a lot of that. I haven't seen as much this year. Brian had still been doing okay, but as far as Cedar City, we haven't seen as many transition as you saw in the last year.
That's an interesting market trend. Yeah. It'll be interesting to see, when the market picks up again, if those, if we see the floodgates move the other way, where long-term rentals are turned back into short-term. Interesting thing. But
so I'll ask you the same question here, Kyle. So because you've been doing this for a while, so what are two things that have got you excited kind of about the real estate market that you're seeing, and two things that have got you a little scared?
Sure. The things I see that are exciting in our market is I still see a lot of California money coming here. I still see a lot of people wanting to move into the Intermountain West, and they're good people. I enjoy helping a lot of individuals that are moving from Vegas or California to buy a home that's in the high desert, and so we still see that influx. Kind of like Ryan Dressel was saying, is that Utah is still a strong market, and we're blessed to be in this area. And so I'm still very excited about the prospect of what's happening in Cedar City, what's happening in southern Utah. We've got a lot of big projects that are coming down the pipe to really drive a lot of future employment here, which will inherently have a need for higher or more housing. And so I don't think we're going to have a housing bubble like some areas. We're going to have steady long-term growth. And so I'm excited about that. I think we've got a great future. It's sad to see Iron County grow. I moved here and I love the small town feel, and I think we'll have that still for quite a while. But we've got a lot of prospect for growth. It will continue to drive and have a lot of investment opportunity. Two things I'm scared with. There's always that geopolitical issue going on. It seems like every day I wake up and I'm like, well, what happened overnight? And so it's an interesting dynamic to have those good things happening in our area, but then a broader scope of our global scope of what's going on. And so that's one thing that worries me, I guess, every day is what's happening on the other side of the world. We're such an interconnected economy anymore that if Europe sneezes, we still feel it quite a bit. China, same story. And so I guess I hope that everybody's economies are moving in the right direction, but that's a difficult hope to have. So that's probably my main concern, is just the geotechnical issues that happen that influence our market every day. And then as far as a second thing that worries me, if rates, if our economy can't get this inflation under control, are we still going to be just strapped with higher rates? And that inflation is sticky. It's created an issue, of course, over the last few years, and we're trying to retreat from that. But it's once you have inflation, it's really difficult. And so, if we can have some measures in our government that would restrict their spending to try to get things back in check, where we can have a more balanced budget, I think that would do a lot for budget or for loan rates. Just any effort on the government to curb spending would absolutely help our market tremendously as far as rate. But if it doesn't, again, it'll fly the other way, and we'll continue to have higher rates, higher for longer, like the Fed chair likes to say. So those are my two concerns.
What advice to make it a smooth transaction if they're looking to buy or refinance their investment property? Just 3 or 4 things that'll make it smooth here to help kill off the last few minutes.
Sure. As far as things to make it smooth, your lender is going to ask for documentation. He's going to have you review things to sign and review. And so your lender is absolutely hamstrung until you give him the information he needs, or she give her the information she needs. And so I think that's the biggest thing right now is documentation has not gone away in most of these programs. Get that documentation up quickly. More documentation is only going to cause underwriters to say, we need this, this, and that, because now we have a question about these few things. So I guess quick responses to your lender is going to be the best way to make things smooth for everybody. It does seem taxing and I'll be honest, a little bit annoying to continually sometimes provide documentation. I have a really wonderful team, 2 ladies that I work with that have been in the business just as long as I have, honestly. One's on 22 years and the other one's on 18. So averages about, the 20 years that I've been in. They know what they're doing. Right up front, they get a pretty good idea of what's going to be needed. They ask for those initially. And so we try to minimize those back and forth fights. I don't want to call it a fight. Sometimes it can turn into a little bit of an argument of, why do you need this? Promise you as a lender, if we ask for it, we do need it. We certainly don't try to ask for things to just see how upset we can make somebody, for sure. But I would say, respond quickly to your lender. If they send something to you to review and sign, review, make sure it's accurate, sign it. It may not be 100% accurate because they're still trying to get estimates on taxes, insurance, that kind of thing, but it's going to be as close as it can be. And that's not the final document until you're actually at the table signing it. And so those documents are important. They allow everything to keep moving smoothly. So get them to your lender quickly. The second thing I would be aware of is, appraisal values are coming in right at what is needed, which I say that because, a year or two ago, if we had a purchase property of, 320,000, our values were coming in at 340,000. Right now, what I'm noticing is that values are coming right at or close to what we need. If it's $320,000 purchase, we might get 320, we might get 325. And so I think that's inherent with the number of days that the sales are on the market, with sellers being a little more apt to come down in price, which is that ebb and flow of the market, which is good because values have gone up quite a bit. Values are still strong, and so getting cash out of your investment property is still a very good thing to do because you do have that equity. Although it might be a tad softer than it was 2 years ago, perhaps. But I think across the board in southern Utah, we're still seeing year over year a 14% increase in value. And so we're still seeing incredibly strong values, but they're not overinflated right now. They're right where they need to be instead of abundantly over. And so I'd say just be prepared when that appraisal comes in that it might not be in the stars like you hoped. It might be a more realistic number.
Well, awesome. Is there any other questions or anything else you would like to add, Kyle?
I would say, where'd my slide go? There it goes. I pride myself in my work. I'd be more than happy to work with local investors as well as national investors that want to invest in Nevada and Utah, which I'm licensed in. I'm available. I try to make sure that I'm available for my clients to discuss. There's a lot of pitfalls. I'm been around the block a little bit. I know what those pitfalls are. Be more than happy to walk through scenario with somebody, give real-time quotes on rates and terms. I had the ability to pull rates anytime, anywhere, because of the access I have to our secondary market and pricing. And so we are, my coworker and I are actually going to be putting together a YouTube video podcast rather soon. We're just getting it off the ground. It's going to be called the Mortgage Guys with a Z. And we'll be doing regular educational and market updates on what those are. We'll start having those videos available probably the beginning of next month. We're going to be pretty regular on what we issue and what we provide as far as information. So I'd invite everybody to check it out. Give it a couple of weeks and then search us up on YouTube for the Mortgage Guys. And we'll have some good information there. But my cell number is there. You're more than welcome to reach out to me anytime via text or phone call. And I'm happy to be a resource to anybody who's interested in this market or refinancing their existing primary, secondary, or investment property, or if they just want to build a home and what that looks like. Premier Mortgage has a true one-time close where we close once on just the construction and long-term loan. It can save thousands of dollars on fees. We only require one appraisal, and that's the first appraisal up front. And so you don't have to worry about, what happens if my property changes in value down the road. Will I still qualify? It won't, because we only do that one valuation. And so risk on our construction product is fairly low because of the measures that we take to make sure that you only have to close one time. But anyway, Derek, I really appreciate you allowing me to be part of this. You do a fantastic job. You're an incredible friend and property owner or property manager owner. And you got a great crew. Thanks for all you do.
No problem. Thank you. Appreciate you going over that.